Hi, this is Ben Hart. I'll be talking to you today about the only stock market strategy video you will ever need. Is it really possible to make a living as a stock market trader at home? Now, I would say almost anything is not impossible, but I will say that 99% of people who try this lose money and lose money bigly. I've seen many lose everything. In fact, everyone I know who has tried to make a living by day trading the stock market has either lost everything, had to declare bankruptcy, or got into serious financial trouble. Many ended up in divorce court because they squandered away the family assets by day trading. I have studied technical analysis and day trading strategies extensively. Now, technical analysis is looking at asset trading charts and trying to identify patterns. People, of course, trade stocks, bonds, commodities, currencies, pretty much everything. What day traders try to figure out is buy and sell signals based on chart patterns. There is an enormous industry of people selling courses on how to trade profitably. And what they rely on is this field called technical analysis. Technical analysis is not based on a company's financials, earnings, or on macroeconomic factors that play a much bigger role in the long-term price of a stock or asset. Day traders who study charts and rely on technical analysis are trying to time micro movements in the price of an asset. What all these chart patterns really represent is public opinion on the price of an asset at that moment, and have nothing to do with the fundamentals of the company. What a day trader tries to do is predict what public opinion will be on the price of the stock or asset 15 minutes from now, or an hour from now, or a couple of hours from now. And if the day trader closes out the day with a profit, well, he's a winner. I've spent quite a bit of time studying this field. I thought that if I could use technical analysis to gain a 5% or 10% edge over the market by really mastering all the buy and sell signals and all these chart patterns, well, that might be enough to make money pretty consistently. It would be like a casino that has about a 6% edge over the players in roulette, or in craps, or in many of the casino games. That 6% edge is enough to pay for all those enormous casinos in Vegas. So that was my thesis. Try to get a 5 or 10% edge over the market by really understanding technical analysis, so that I would recognize all the buy and sell signals and all those chart patterns. So I learned all about the Fibonacci ratio, the Fibonacci number sequence, Bollinger Bands, momentum indicators, the absolute price oscillator, the accumulation distribution line, the volume weighted average price chart, the Andrews pitchfork, the Arun oscillator, the average directional index, bear traps and bull traps, the bearish diversions, the bump and run reversal, the Chaikin oscillator, the Shand trend meter, the chandelier exit signal, the dark cloud cover, the dreaded death cross, the descending triangle, the D-trend price oscillator, the directional movement indicator, the double bottom breakdown, the double bottom reversal, the double exponential moving average, the double top breakout, the double top reversal, the Dow theory buy signal, the downside Tsuki gap, the dragonfly doji pattern, the exhaustion gap, exponential moving average, the falling wedge, the flag pattern, the pendant pattern, which is sort of like the flag pattern but longer. There are also various gaps that need to be filled. There's the breakaway gap, the continuation gap, the exhaustion gap, the measuring gap, the up and down gap, and there's the golden cross and the golden ratio. There's the gravestone doji, the hammer pattern, the hanging man pattern, the harami cross, the head and shoulders top, the upside down head and shoulders bottom. There's the Hindenburg omen. That's bad. There's the whole moving average, the Ikimoku cloud, the inverted hammer, Kaufman's adaptive moving average. There are Keltner channels, a linear regression, a long-legged doji. There's the moving average convergence divergence histogram. There's the McClellan summation index, the money flow index, the morning star and the morning doji star patterns. There's the moving average ribbon, a negative directional indicator, the parabolic SAR indicator, the percentage price oscillator, the percentage volume oscillator, the piercing line, and the pivot point. There are point and figure buy and sell signals and the price momentum oscillator. There are call and put options, and there's the put to call ratio. There are quadrant lines, the rectangle pattern, the relative strength index oscillator, the relative volume ratio, the relative time of day indicator, and there are resistance levels, retracements patterns, and reversal patterns. There's the reversal spike, the rising wedge, the rounding bottom, the runaway gap. I prefer a rounded bottom to a square bottom, especially in women. There are stop and reversal indicators, support levels, symmetric triangles, and the TED spread. There's the triple exponential moving average and the three black crows pattern, as well as the three white soldiers pattern. The triple bottom breakdown, the triple bottom reversal, triple exponential moving average, triple top breakout, triple top reversal, the TRIX momentum indicator, and the TTM squeeze. There's the upside gap, the two crows pattern, and the upside Tsuki gap. There are wedge patterns and whipsaw patterns, plus there's the zigzag overlay. And there are countless trading theories and models. There's Elliott wave theory, random walk theory, and revert to the mean theory, to name a few of these theories and models. So I learned all this and more, and I back-tested many models. I put $10,000 into a trading account, and I started playing around with all this. I bought call options, and I covered bets with put options. I shorted the market and longed the market. I also did some currency and cryptocurrency arbitrage trading. And here was my bottom line conclusion. This was all a colossal waste of time. Now, I didn't lose a lot of money. I was pretty close to break even after all of this. But think about all the time I lost when I could have been doing productive things. I could have spent all that time earning money or perfecting a skill instead of staring at the computer screen for hour after hour. Lying on the beach with Wanda and watching the seagulls would have been a far better use of time than trying to use technical analysis to spot buy and sell signals on a trading chart. I have also talked to career Wall Street traders to ask them what I did wrong. They basically said I was doing nothing wrong and that there's basically nothing to this day trading thing. That it's no better than trying to read smoke signals or it's no better than palm reading. And that generally the reason professional Wall Street traders trade is to hedge a bet on an investment they've made or that the firm has made. Or they're just brokers executing a trade that someone else has put in. So they're earning a commission. They aren't making a living by correctly guessing what the price of a stock will be in 15 minutes or in an hour. The way Wall Street makes money is by selling and by earning a commission or a fee for executing a trade on behalf of someone else. What the self-proclaimed day trading guru who is trying to sell you a course fails to mention is the transaction cost of each trade, and how this transaction cost fatally tips the odds against the day trader, even if you guess right on the direction of the market most of the time. Yes, most exchanges like E-Trade offer what they call no-fee trading, a trend that was started by Robinhood. E-Trade used to charge $9 per trade. So most of the exchanges pretty much got rid of this fee, but that does not mean there are no fees for each trade. Trades are executed by market makers who charge a commission of around 1% to execute the trade. Plus, what market makers do is they buy an inventory of stock shares. Market makers are needed to provide liquidity to the market. Market makers make their commission, plus they make money on the spread at which they bought the shares and then sell the shares to you. So when you buy your shares of stock on E-Trade, you really aren't buying the stock at the true price. You are buying the shares at whatever price the market maker is willing to sell them to you. This spread might be 1% to 3% or more, in addition to the 1% or so commission. In other words, there's no such thing as no-fee trading. But that's not the biggest transaction cost, nowhere near it. The biggest transaction cost is taxes. If you hold an asset for more than a year before selling it, and if you make a profit on the sale, you pay taxes at the capital gains rate, which is 20% at the moment. If you sell an asset that you've held for less than a year, you pay at the regular income tax rate, which might be 25% to 50% or more, depending on your income tax bracket and what state you are living in. California, for example, has a top income tax rate of 13%. So that would be in addition to your federal income tax rate, the top federal tax bracket being at 37%. So that's a potential 50% tax on whatever you earn by day trading. Now, the stock market does have an upward bias. The stock market goes up about 53% of the time on average. This means that if you keep your money in a stock market index fund, such as the S&P 500 index, and never sell, You have about the same odds of winning as a Las Vegas casino. You will win about 6% more than you will lose. That 6% odds advantage is what builds all those enormous casinos in Las Vegas. So you have the same odds as a Vegas casino, a 6% advantage, if you just keep your money in an S&P 500 index fund, such as SPY, SPY, or VOO, and just never sell. Just hold through thick or thin. But the moment you sell, if you have a gain, you will owe taxes on your gain. And that's why you want to never sell unless you absolutely have to live. And when you are ready to sell some of your holdings so that you can live a comfortable life in retirement, hopefully you'll be paying at a lower 20% capital gains rate. Hopefully, unless they change the law, and not at the income tax rate. So taxes is what tips the odds fatally against the day trader. But yet there's still a bigger cost of day trading than taxes. Your biggest cost is your time. Time is your most valuable resource. You can never get your time back. As a stock or commodities trader, you are spending all day in front of a computer screen trying to figure out, well, is this a V-shaped bottom reversal or is it a dead cat bounce? Is this a market breakout or is it a fake out? What's going to happen at the end of this descending triangle? Will we see a breakout to the upside or a breakdown to the downside? Or perhaps the market will just trade sideways. No one knows. Now you can always identify the pattern after the fact. Oh, that turned out to be a head and shoulders top, not a couple of bounces followed by a continuation of trend. Or, oh, that turned out to be an upside down head and shoulders bottom, not a couple of bounces and then a continuation of downward trend. The pattern is always obvious after the fact. The problem is identifying what the pattern is in advance. We'd all be billionaires if we could really identify these trading patterns in advance. That's why these so-called traders who are sending you courses on how to day trade and how to make money by trading, that's how they're making their money, by selling you the course, not actually by day trading. Technical analysis is like palm reading. You might as well go to a psychic and ask her what she thinks is going to happen. CNBC's commentators and analysts are always telling us why the market did what it did after the market closes. But if CNBC and their analysts really knew anything, they would be able to tell us what the market is going to do in advance, before it happens. Hindsight is always 20/20, and we can always rationalize what happened after the fact. All we can be pretty confident of is that the market will go up about 53% of the time, because that's what's happened over the last 100 years or so. And that's assuming we don't have some sort of economic and political system collapse. Then all bets are off. And that certainly could happen. But also, breaking news events affect the overall direction of the market for that day more than anything. There's no way to predict breaking news events, which make day trading futile. According to Warren Buffett, the greatest investor of all time, the best strategy for 99% of us is just to buy a stock market index fund and forget about it. Buy an S&P 500 stock index fund, ticker symbol SPY, SPY, or VOO, VOO, or buy a NASDAQ 100 index fund, ticker symbol QQQ, and then just hold forever. Never sell. Forget about it. Well, until you retire. Then you can start taking out a little at a time as you need it and pay the 20% capital gains tax rate. The way to get rich is to focus your time on earning money at whatever it is that you're good at, so that you have some money to invest in these index funds. Over time, the S&P 500 index has returned about 11 or 12% per year on average. The NASDAQ 100 or QQQ has returned an average of about 14% per year over the last 20 years. The NASDAQ 100 is made up of the 100 biggest companies on the NASDAQ stock exchange. Companies like Apple, Google, Microsoft, Amazon, and the biggest tech companies. The NASDAQ stock exchange is mostly big tech companies and tends to be more volatile than the S&P 500 index. The S&P 500 is made up of the 500 biggest companies traded on U.S. stock exchanges and is more diversified than the QQQ, than the NASDAQ 100. Now let's take a quick look at what happens if you put just $100 per month into an S&P 500 stock index fund because of the law of compounding returns. Now, the S&P 500 as a whole has returned an average of 12% per year for the last half century. This means if you put just $100 per month into the S&P 500 for 40 years, you will have $1.2 million 40 years from now, assuming everything goes along the way it has for the past half century. And you will have only put in $48,000 during this 40-year period. This happens because of the miracle of compounding, the law of compounded returns. And you can do the math yourself by heading over to moneychimp.com and using the compound interest calculator.
Let's learn. Money, money, money in my pocket. Money, money, I know how to count it. Money, money, money in my pocket. Money, money, I know how to count it.
I really like this tool because it inspires me to save money and to invest in a stock index fund like SPY, or QQQ. That's the NASDAQ 100. Now, the reason the law of compounding returns is so powerful is you are making the 12% per year not just on the money that you put in, you are also making 12% per year off the 12% that's building up each year on average. Now, as you probably know, the 12% return is not automatic each year, it's an average. During the 2008 financial crisis, for example, the S&P 500 dropped 50%. So this can, does, and will happen periodically. You have to expect it. But remember, your strategy is just to put $100 per month in there and forget about it. And if you hold on to your S&P 500 stock index fund over time and just keep putting money in every month, $100 per month like clockwork, or better yet, 10% of your gross income before taxes, you will be rich. Assuming we don't have a complete political system and economic system collapse. But short of that, you should be fine. Now, my preference is actually the NASDAQ 100, the QQQ, the 100 biggest companies on the tech-heavy NASDAQ index. But it is substantially more volatile than the S&P 500. The NASDAQ 100 has generated an average compounded return of 14% per year over the last 20 years. So if you put $100 per month in the QQQ, the NASDAQ 100, for 40 years, and if it continues to average 14% returns each year, instead of 12% from the S&P 500, well then, you'll have $2.2 million in 40 years for the $48,000 that you put in during that time. Now, I don't offer financial advice, I don't know your situation, but this is what I tell my kids to do. I tell them to split their monthly investment between these two indexes, the S&P 500 and the NASDAQ 100, and commit to putting 10% of your gross earnings before taxes into these two stock index funds, and then just forget about it. Don't worry about the volatility. Check it in 40 years. Of course, you won't do that. You'll check it probably every day, as most people do. But ideally, you just put it in there and you just forget about it. And then focus on making money, on making a living, so that you will have money to put in these two index funds every month. This is called dollar cost averaging. You're going to be doing this every month or every paycheck, every 2 weeks perhaps. And sometimes you're going to be buying when the market is high, when it's at a peak. And sometimes you're going to be buying when the market is down, so you're going to be getting bargains. But over time and on average, the market is likely to return 11 to 13% per year on your money, compounded yearly returns. For 99%, I would advise not to invest in individual stocks. Too much can go wrong if you invest in a single stock. So unless you are studying one company pretty much full time, investing in a broad index of stocks is best, such as SPY, or QQQ. Diversification and patience is the key to building wealth. I also very much like real estate, but that's a topic for another video. Now also though, understand that there will be long periods when the stock market is heading down or doing nothing. An entire decade or more can pass without the stock market doing much. We did have the Great Depression starting in 1929, which was then followed by World War II. The stock market was down from the mid-1970s to the early 1980s during the oil shortage, the Cold War, and the Iran hostage crisis. We saw the tech bubble of 2000 that crashed the tech-heavy NASDAQ index 80%. And that was followed by the 2001 terrorist attack on the World Trade Center, which was followed by the financial collapse of 2008. Wars and disasters happen, which can and will send the market crashing. But remember, you're going to be dollar cost averaging every step of the way, taking 10% of your gross income before taxes every paycheck and putting that money in a stock market index fund like QQQ and SPY. Sometimes you're going to be buying when the market has crashed and is at a low point. That's good. Sometimes you're going to be buying at the market tops. Most of the time you'll be buying somewhere in the middle range. Some years you'll be getting 50% returns on the upside. Other years you're going to see 50% declines. But on average you'll be getting 11 to 13% annual average compounded returns, assuming we don't have a complete political and economic system collapse. And 11% annual compounded returns over 40 years will make you rich, even if you're only putting in $100 per month into SPY and QQQ. Or let's take a worst case scenario. Let's say you invested $100 in the S&P 500 in August of 1929, right before the stock market crashed 90%, which ushered in the Great Depression. The Great Depression lasted a decade, and then we had World War II. So not good. Pretty much the worst case scenario. I guess the worst being losing World War II. Good thing that didn't happen. Well, if you had invested just $100, not $100 every paycheck, not $100 every month, just $100, just before the stock market crash of 1929, well, that $100 would be worth $560,000 today. And imagine if you had started investing just before the stock market crash of 1929, if you'd just started investing in August of that year, 1929, quickly followed by the 90% stock market crash, and if you had invested $100 every month, including at the absolute bottom every step of the way, how much do you think you'd have if you had invested $100 every month, starting with just before the stock market crash of 1929? Well, you'd have $327 million today. Well, you wouldn't because you'd be dead, but your kids and your grandkids would. And that's just assuming an 11% annual average return. That's what the miracle of compounded returns can do for you. And remember, you don't pay taxes on any of this until you sell. That's why you never want to sell, or only sell when you absolutely need to survive, or when you retire and you need some of that money to live. That's how you create generational wealth. And that's why you also want to invest in a broad index of large cap stocks, like an S&P 500 index or a NASDAQ 100 index. Also, it's important to realize that the composition of these indexes is changing all the time. The S&P 500 looks very different today than it looked in 1950. So you tend to always be investing in the best companies. Any company that makes it onto the S&P 500 or the NASDAQ 100, you can be sure has a pretty good business model. But companies that were great in 1950 might not be so good today. Probably aren't. RCA and Kodak were once great companies, were great investments at one point. But you would not have wanted to hold these stocks when their businesses collapsed. And at some point in the future, Apple, Google, Microsoft, Amazon, and the big tech companies that you know about are likely to be replaced by something better. By always investing in the 500 biggest companies, the S&P 500, well, the index is always rebalancing itself as the poor performers drop off and are replaced by the better performers. Same with the NASDAQ 100. So just invest in the big index of stocks, of large cap stocks, the S&P 500 and the NASDAQ 100, SPY, SPY, and QQQ. It's very difficult to beat the overall stock market over time, especially the 500 biggest companies, the 500 best companies. 70% of professional money managers and stock pickers who do this for a living, full-time, perform worse than the stock market index that they are targeting. Worse than the S&P 500. That's right, 70% of professional money managers and stock pickers perform worse than the S&P 500 index over time. And that's because the market, the stock market, is like a giant supercomputer. Even professional money managers and stock pickers can't beat it. So there's really no reason to think you can. Now, the greatest investor of all time is Warren Buffett. He's worth about $120 billion, started with almost nothing and now worth $120 billion. But even he says his success comes from making just 12 correct decisions during the course of his 7-decade career. He's 92 years old. Now, as the greatest investor of all time, Warren Buffett has managed to get a 20% compounded rate of return each year on average. You're not going to beat Warren Buffett, not over time. And Warren Buffett says that 99% of people are just better off putting their money in an S&P 500 index fund for decades and forgetting about it. And if you want to add maybe 1 or 2% to your average annual return over time, maybe split your investments between SPY, that's the S&P 500 index, and the QQQ, which is the NASDAQ 100 index. And then forget about it. Then spend the rest of your time earning an income. So you can invest 10% of your gross pay every paycheck into SPY and QQQ. And that's how you get rich in the stock market, not by day trading. And that's why this is the only stock market trading strategy video you will ever need. Well, that's it for now. If you like this video, please be sure to hit the like, subscribe, and notifications buttons, as this helps with the algorithms. Also, check out my new book, Win Life: Success Skills Schools Don't Teach. Anyone who follows the advice in this book is sure to be in the top 1%. It's available on Amazon in all the formats: print, Kindle ebook, and audiobook. Hey, thanks for watching. Hope to see you back here for the next video.